We have a interesting session now with a paper and then a keynote speech. The paper will be presented by, it's a paper by Vania Stavrakeva and Jenny Tang, and the paper will be presented by Vania, and you have 35 minutes.
So thank you very much to the organizers for inviting me to present in this super nice conference. And Jenny is also here, so she can answer questions both in the chat during the presentation, but also after in the Q&A session. So just keep all the hard questions for her, please. So the title of the paper is "The Door During the Great Recession, U.S. Monetary Policy Signaling and the Flight to Safety." So the motivation is actually quite straightforward for this audience. Essentially, the conventional wisdom in macroeconomics is that when a country lowers a home country's interest rate relative to another, we expect that the currency will depreciate. So this is kind of coming out of the standard New Keynesian models that we're used to. And this belief was also echoed during the global financial crisis when the US engaged in unconventional monetary policy. So here we have a quote from a piece by Ben Bernanke titled "Federal Reserve Policy in an International Context." And in that piece, he says, "I heard two related complaints at international meetings and through the media. First, that the US was engaging in currency wars by choosing policies that would weaken the dollar and thereby in fail increase US competitiveness at the expense of trading partners." So essentially this belief also, Bernanke himself believed that indeed, this was the mechanism operating during the global financial crisis. So what are the key findings in this paper? So first, we find that actually exactly the opposite was happening. So we document that US monetary policy easing had the opposite effect during the Great Recession. So the dollar appreciated rather than depreciate. We attribute this to calendar-based forward guidance in particular. And the story that we put forward, and we will try to persuade you that the story is correct using various empirical facts, is that the signaling, essentially forward guidance signaled economic weakness, which resulted in a flight to safety effect and lower expected inflation in the US, both of those contributing to the appreciation of the dollar. Moreover, we document a set of interesting cross-currency heterogeneity. So for example, a surprise US rate cut induced a larger appreciation of the dollar against currencies that tend to depreciate by more when US real output growth is low. So effectively, these are currencies that are not a good hedge from the perspective of the US investor. And then at the end, we build a partial equilibrium model that can reconcile all of these results. So this is the agenda. So let me just jump straight into the key empirical fact. So the key empirical fact can be summarized by this two-stage least squares regression. So on the left-hand side, we have the exchange rate change at quarterly frequency. And on the right-hand side, we have F tilde, which stands for the foreign minus US 2 to 10-year forward rate. So we're going to be estimating panel fixed effects regression when Driscoll creates standard errors. And we'll be instrumenting this relative forward rate, essentially. So the changes in future implied yield over 1 hour window around FOMC and Q announcements will be instrumented with in a second. I'll tell you what the set of instruments are, where we're going to allow for currency pair specific first stage relationships. So what are the instruments? Given that we are studying the unconventional monetary policy period and the zero lower bound, it's important to use not the Fed funds rate actually over this period, but essentially futures that capture revisions in market expectations over the whole yield curve. So we are going to use the Fed funds rate actually only in the pre-zero lower bound period, and in the zero lower bound period, we're going to use the 3-month Euro-dollar futures expiring in 4 quarters and 2 and 10-year Treasury bond futures expiring in the current quarter. So we are going to also run a number of other regressions that do not have the exchange rate change on the left-hand side. In that case, there'll be another variable X on the left-hand side. And on the right-hand side, we're going to have the change in the US forward rate rather than the relative forward rate. And again, we're going to be using the same set of instruments. So the data and the sample, so it will focus on quarterly frequency. So for, we consider this to be a policy relevant, one of the most policy relevant frequencies. The sample, the whole sample that we're going to utilize is from 1990 to 2015, pretty much the end of the zero lower bound for the US. However, the focus of the paper is on the global recession, which we're going to characterize between 2008 Q4 and 2002 Q2. So we're going to consider the dollar value against 9 developed economies, and here you have the list of the most liquid currencies. Now, what is the key empirical fact that we document? So what you have here is the estimates from this two-stage least squares regression, where on the left-hand side you have the exchange rate change, and on the right-hand side you have the relative forward rate, the 2 to 10-year forward rate instrumented using this set of high-frequency instruments. If the coefficient is negative, then it says that the exchange rate moved in the direction consistent with the conventional wisdom. If it's positive, it means that it moved exactly the opposite way. And that's what you notice here, that prior to the early zero lower bound and during the late zero lower bound, indeed, we find that the relationship between monetary policy and the exchange rate is consistent with the conventional wisdom. However, it looks very different over the early zero lower bound. Now, you might wonder, why did we pick this period for the global financial crisis? So there are two reasons. Actually, foremost, structural breaks identify this period as well. And second, this is going to coincide with the period during which the US engaged in calendar-based forward guidance. And later on, you will see that the calendar-based forward guidance is at the heart of our story that we're going to document. Okay. Now, what about the cross-country heterogeneity? Well, you see very nice sorting. So here we're estimating a panel regression. Here we're estimating country-by-country regression. So on the y-axis, you have the country-specific estimates of this regression that I just described. And on the x-axis, you have two different measures. Here we have the covariance of the real US GDP growth and the exchange rate growth. And here we have the covariance of the market value growth of the intermediary sector in the US and the exchange rate growth. So as you're going to see later on, this will be essentially variables that will be essentially supported by our model as driving this heterogeneity. But both real GDP growth and the market value growth of intermediaries can be used as a proxy for the SDF of the marginal trade value. You'll see why we use these particular variables. However, you can see that the sorting is quite striking, regardless of which measure you choose to use, where the Swiss franc and the Japanese yen tend to be quite different from the rest of the countries in the sample. So actually, they did not end up depreciating against the dollar during the global financial crisis in response to negative surprises coming from US monetary policy. Actually, they ended up appreciating. So they moved in the direction of the conventional wisdom. However, the majority of the countries in the sample ended up actually depreciating. So, and why are they special? Well, what happens is that actually the Japanese yen tends to appreciate against the dollar during bad times. And so is the case for the Swiss franc, while the opposite is true for this set of currencies. We're going to refer to this set of currencies as not hedge currencies, and here we mean from the perspective of the US investor that bonds denominated in these currencies are not a good hedge for the US investor. If you have any questions, Jen, you can answer in the chat, by the way. Okay, perfect. So here what we do is we estimate the same panel regression, but we isolate Switzerland and Japan, which is the light gray dots, and you can see that indeed actually we don't see a structural break for them, and the dark gray dots represent only the non-hedge currencies. Okay, so now we have this fact. What do we do with it? Well, we're going to use a well-known decomposition in the literature in order to isolate what is the channel through which that led to the exchange rate appreciation in response to US monetary policy easings during the early zero lower bound. So there are quite a lot of papers that have used similar exchange rate decomposition. So you see them listed up here, up to this point. And essentially, what is that decomposition? Well, you can express the expected excess return as, so here we're expressing the expected excess return from investing in nominal one period US dollar debt relative to country I debt or foreign debt. And what you have is that the sigma, which is the expected excess return, is defined as the interest rate in the US minus interest rate in foreign plus the expected exchange rate change. And here we define as I tilde the foreign interest rate minus the US interest rate. When you iterate this equation forward, what you get is the following expression. You see that the exchange rate change can be expressed as a function of the interest rate differentials in period T, the currency risk premium or the expected excess return in period T, and three forward-looking components. And what are those? This component captures the revisions in expectations over the whole monetary policy path. So any kind of unconventional monetary policy will be also captured here. This component is the revisions in expectations over the currency risk premium, the whole path of currency risk premium. And this component is essentially the long run component, which you can think of actually as the revisions in expectations over the relative inflation paths. In order to get these results, that this component is the revisions in expectations over the relative inflation paths, the only assumption that you need is the real exchange rate is mean reverting. And by the way, it can have potentially structural breaks, but it has to be mean reverting. There could be structural breaks in the mean and the results would still stand, but it needs to be mean reverting to some mean, even if it's temporary. Okay, so this is the estimated response from the two-stage square. So this is how we denote it. So this is effectively the main result that we showed you already. And actually, we can decompose this regression coefficient as using our decomposition, right? So in this two-stage squared regression, on the left-hand side, we can just put the various components of the exchange rate change. So this is the monetary policy component, this is the currency risk premium component, and you can think of this component as the relative inflation paths. Okay, now I forgot to mention actually how we're going to estimate the different terms. So this comes in a different paper of ours, where actually it's quite important to estimate these expectations correctly. So what we do is we discipline the VAR that we use using survey data. So what that means is actually we make sure that the VAR implied expectations are consistent with the survey data. So we introduce additional constraints in the VAR. The reason why it's important is because if you just run a simple VAR, what you're going to see is that your long run forecast for inflation, for example, are going to be unrealistically flat, which is a standard problem in the VAR literature. And actually using survey data to discipline the VAR in this way is an alternative to, for example, long-term priors, for those of you familiar with the existing problem in the VAR literature. Okay, so if you're interested in that, I refer you to our paper. Okay, so now we're going to effectively plot the composition of essentially this coefficient, which is estimated by regressing the exchange rate change on the instrumented relative forward rates. So this can tell us actually through what channel, what led to the dollar appreciation. So it's quite clear, right? So your red component is your excess returns path. So this is the revision in expectations over the relative currency risk premium. This is the blue component is the revisions in expectations over the relative inflation paths. You can see that both of those actually contributed to the appreciation of the dollar. So what we see is that appreciation of the dollar in response to Fed easings was due to lower expected future excess returns from holding the dollar, which we are going to attribute to flight to safety, and lower expected future inflation in the US relative to the other countries. Notice that the estimated coefficients are quite different over the pre and after the zero lower bound period, and the theory that we're going to establish actually is going to reconcile all these three periods. So the transmission through future nominal short rates is relatively small and consistent with the conventional wisdom. So a negative coefficient on the green implies that actually this is consistent with the conventional wisdom. Now, this graph is very important for this conference, and let me tell you why. So often, unfortunately, in international finance, for simplicity, we end up essentially not having a model of the currency risk premium, or we resort to a model of the currency risk premium where it's just a function of an exogenous shock. However, this will be misleading because notice that here it's the currency risk premium which is the main transmission channel of monetary policy. So monetary policy is strongly correlated with the currency risk premium. So the models that we write need to have endogenous risk premium, and it needs to match the particular set of empirical facts that we document in this paper and other people potentially might document in other papers. So I would like to emphasize that on this slide because it's quite relevant for this conference. Okay, now we can use the decomposition to see which component can explain the sorting that we saw in the exchange rate. So notice that when we put on the left-hand side the expected excess return component, and then we regressed on the instrumented relative forward rates, and when we plot this against the covariance, it's indeed the currency risk premium component that can explain all the sorting, and the model that we're going to present is actually going to be consistent with this result. If you do the same with inflation, actually you don't find the same sorting. So let me emphasize it once again, whether the currency is a hedge or not from the perspective of the US investor matters for the response of the expected excess return component. but not the relative inflation component. So what is the theory? So we are going to write a very basic partial equilibrium model of the stochastic discount factor of the marginal investor and monetary policy signal. This will be the bare bone, essentially, assumptions that you need to generate the result. So this is not your big general equilibrium model, but is, I think, a quite useful model of the currency risk premium that can be taken and embedded into the type of big models that we just saw in the previous presentation. So what's partial equilibrium is essentially the data generating process for output inflation, and you have a Taylor rule. So we assume that output is given by this exogenous process. So this is effectively an output shock or demand shock in this particular model. And then it's also negatively related to the real interest rate. So this is the nominal rate minus inflation. And then we assume that inflation is just a function, where alpha is positive of output. So essentially we have only demand shock in here. And you have your Taylor rule where the interest rate is a function of output inflation, and this is the monetary policy shock. So you have two shocks. You can think of it as demand shock, output shock, and a monetary policy shock. They're assumed to be ID normally distributed and uncorrelated. And you have a similar data generating process for the other country type. So of course you can express all of these variables as a function only of the exogenous shocks. And now let's go to the meat of it, which is what do we assume about the stochastic discount factor? So consider the Euler equation of the marginal trader located in the US, who is long one period US bond and short one period bond in currency I. So this is something that you're all very familiar with, where the stochastic discount factor is just the real SDF of the marginal trader. ST is the nominal exchange rate defined as units of currency I per $1 US. So this is defined the same way as in the empirics. And then conditional on assuming normality, we can further express the currency risk premium or the expected excess return as a function of the variance of the exchange rate and the covariance between the real SDF and the exchange rate change. Again, very familiar from your asset pricing classes. Now, how do we, so here, of course, we need a model now of the currency risk premium, right? So what is going to make this currency risk premium correlated with the monetary policy shock in a manner consistent with what we saw in the data? So we take literally the most basic, simple model of time-varying risk aversion. So here we're going to use CRI preferences. We're going to assume that the coefficient of relative risk aversion is time-varying. So if you take the log SDF, you can just express it in the following way, which is going to imply that your sigma T or currency risk premium is a function of a bunch of terms, but we're going to actually assume that these covariances are constant in the data, which implies that the only reason why sigma T varies here is because of time-varying currency risk premium. Part of the reason why we don't focus on time-varying covariances is because when we try to essentially allow for that, we realize actually the main variation that we are finding is through rho T or the currency risk premium, and you're going to see in a second why I'm saying this. So once again, sigma T or the currency risk premium varies because we have time-varying currency risk premium. However, remember this hedge non-hedge discussion is going to be captured by the covariance of the growth rate and consumption and the exchange rate change. So depending on what model you want to write, there'll be different proxies for consumption here. Okay, so now the key is how do we model rho and why do we model it in this particular way? So we assume that rho T has the following data generating process. So you have this, we allow for a risk aversion shock, but that's not crucial for our story. It's just more to match the data. You can shut it off completely. So this empirical process says that the risk aversion will be higher if agents revise their expectations of the path of US real GDP growth downwards. What type of theories can essentially be consistent with this type of time-varying risk aversion? Well, what are the asset pricing theories that allow for time-varying risk aversion? Of course, you have the habit formation literature. And in that literature, they model risk aversion is increasing if there is negative news on consumption output. So that's kind of a similar flavor to this. Also, it's kind of consistent with intermediation-based asset pricing literature. So for example, Kelly and Manella is the paper we're going to build on, and we're going to use their risk aversion measure. So in that literature, risk aversion is a function of intermediary leverage, which is higher when the economy is doing poorly, and why essentially this type of models assume that risk aversion is a function of leverage. Well, if you think about a model where potentially you have leverage constraints, essentially risk aversion is effectively given by the Lagrangian of those constraints in the title when leverage is high. So this is one way to microfound it. The purpose of this paper is not to microfound it, but just to give you kind of various measures that could proxy different literatures that can potentially microfound the time-varying current series premium. But regardless of which story you pick, there is a correlation between output and risk aversion that we assume in this model. Now, where is the signaling part, right? So we assume that here the central bank has superior information relative to markets. Now, I know this is a controversial assumption, and I'm sure Eric is going to speak to that later on. Essentially, what we need is that markets, one, so there are different ways to do it. One, markets believe that the central bank is better at analyzing information, so their forecast is better. Two, essentially, they might believe that other market participants coordinate on the information by the central bank. So that's why they put a weight on this public signal. So these are effectively two ways of microfounding these assumptions if you don't want to believe that the central bank has better information at the markets. But for simplicity in this model, we see that in T plus H period from now, the central bank observes the two shocks, and forward guidance is effectively the central bank announcing what the interest rate will be in T plus H, and this will be T plus 1 will be the forward guidance announcement to the monetary policy announcement in this model. So the agents have a common prior distribution of shocks and see this announcement, so there's no private signal in this model. So how are we going to link the empirical results to the model? Well, effectively, under some minor assumptions, the estimated coefficients map to derivatives that we can solve for in the model. So the key thing is that both of those derivatives are proportional to the effect of this monetary policy announcement on the expected future real GDP growth. So once we derive this comparative statics, we pretty much are almost done. So let's do that. Well, what is the derivative of the revision of the GDP growth forecast with respect to this forward guidance announcement? Once you solve the signal extraction problem, it's just equal to this K. So this capital K is the key parameter in this model. So let's discuss what this parameter is. Well, the derivative of the US output revision with respect to the conventional monetary policy is indeed given by the K. Now, K will be positive if the variance of the output shock over the variance of the monetary policy shock is high enough. What does it mean high enough? It has to be greater than this particular parameter, and the other way around. So if K is less than 0, this implies that the negative monetary policy surprise leads to higher expected future output. So this is what the literature calls the direct effect of monetary policy, right? If there is negative surprise, actually markets would expect that the GDP growth will increase in the future due to the direct channel of monetary policy, because real rates are lower and they stimulate growth. So, for example, why would that be the case? Well, if there is no uncertainty over the future demand shock, this term would be 0. This is just one example. And in that case, AT plus 1 will be interpreted only as a signal about the interest rate shock, so only the direct effect of monetary policy will be present. If K is greater than 0, this implies that the negative monetary policy surprise leads to lower expected future output. So this is what people call the signaling channel of monetary policy. We're going to argue that over the global financial crisis, actually K was greater than 0, meaning that essentially this variance of the demand shock relative to the monetary policy shock was quite high, so that K is positive. Now, how do we now solve for this coefficient or the comparative statics in the model? Well, you can express effectively the regression coefficient from the expected excess return on the instrumented relative forward rates in the following way. Remember, in the data, we estimated it to be positive. So it's equal to this essentially set of parameters. Under what conditions would this be positive? Well, if you have strong signaling channel of monetary policy, stronger than the direct channel, K0 will be positive. And on top of that, if the covariance between the consumption growth and the exchange rate is negative, meaning that the bond denominated in currency I is not a hedge for the US investor, so this would be UK, New Zealand, Australia, so on and so forth. So these two combined actually is going to tell you that this estimated coefficient will be positive, which is kind of what we see in the data. So in terms of what about the inflation component, remember the inflation, the revisions in expectations of the inflation path also contributed to the appreciation of the dollar over the global financial crisis, well, it's enough that we have strong signaling channel of monetary policy, and indeed we're going to get that result. So note that the theory is also consistent with the empirical fact that effectively the inflation buff component is not a function of the hedging properties of the currency, while we observed the sorting over the estimated coefficient of the regression of the currency risk premium on the relative forward rates instrumented with monetary policy surprises. Okay, so now we derived a set of testable implications coming out of those models. Some of those we already presented empirical evidence supporting those, but also the model gave us other things that we can test in the data. So first of all, was K positive? Was the signaling channel stronger over this period? So what we're doing here, we're estimating the same two-stage risk coverage regression. On the left-hand side, we have the revisions in expectations over GDP growth using survey data. And on the right-hand side, we have the instrumented change in the US forward rate. So when you estimate it over the different periods, you find that actually the signaling channel is present only over the global financial crisis. It's very, very significant. And if anything, prior to and post the financial crisis, the direct effect is stronger, even though the results are not really significant here. So this period was indeed special. And, and now we'll continue persuading you that that was the case. So what can we do next? Well, there are very strong predictions coming from the model that risk aversion was very important transmission channel in the story, right? Because our currency risk premium was time varying, because risk aversion was time varying. So let's use various proxies of risk aversion that people have used in the literature. One is the VIX. So this is an alternative measure, which is coming from a paper by Becker, Ng, and Zhu. They are estimating it based on the VIX, but they're essentially estimating just the risk aversion component from the VIX. And this is your leverage, market-based leverage measure from the Hem, Kelly, and Manella. So you can see that indeed, this is the early zero lower bound period. What you see is that risk aversion rose in response to Fed easing during the global recession, and the results are very statistically significant no matter which measure you use. Then your second concern might be, well, but you're telling me that this is coming only through the fact that risk aversion is correlated with GDP growth expectation revisions. So let's try that. Well, what we do here is we are cleaning out the GDP growth expectation revisions from the risk aversion measures that we have. And we regress that cleaned out measure on the instrumented change in the US forward rate. And you see that actually the results are no longer significant. So this is telling you that indeed the risk aversion measures usually used in the literature indeed responded to the monetary policy shock, meaning they increased in response to monetary policy easing over the earlier zero lower bound of the global financial crisis, precisely because of their correlation with GDP growth revisions. And that's what it's telling you here. So it is consistent with the theory and the signaling channel of monetary policy story. So the next question is, why is the middle period special, right? The theory told us that the signaling channel is stronger than the direct channel of monetary policy only if economic variance, or the variance of the GDP, is stronger, is higher than monetary policy variance. This ratio had to be high. So what are the proxies of those variances that we can find in the literature? So we have the Jurado et al. Measure. So this is a measure of macro uncertainty that probably many of you are familiar with. Then we also use the GDP forecast dispersion as well as another proxy of economic uncertainty. And then for monetary policy, we're going to use the Becker et al. Monetary policy uncertainty. And then you have the three periods. You can see that indeed uncertainty over GDP and output is significantly higher in the middle period. Not surprisingly, this is the global financial crisis, while monetary policy uncertainty fell because of the zero lower bound. So indeed, it's a very special period with very high economic uncertainty. You need that in order for the signaling channel to dominate the direct channel. So you're not always going to get this kind of signaling dynamics in the data. Now, let me give you a little bit. How many minutes do I have? I'm sorry.
Oh, you have 6 minutes.
Okay, yeah. Perfect. So let me give you some more kind of support about the forward guidance. Why do we believe it's forward guidance? And at the end, I'm going to present some results coming from a complementary paper that Jenny and I have that will really hopefully persuade you it's coming from forward guidance rather than QE. So economic uncertainty was especially high during the global recession. So during the immediate aftermath of the financial crisis, so that kind of explains the previous set of results. But moreover, what happened over this period of time is they moved, so effectively they moved from date-based to threshold-based forward guidance in December 2012, which is essentially when we timed the end of the global financial crisis, which is for the structural model as well chooses a separate. So the following announcements were quite common over this early zero lower bound period, which, we had the calendar-based forward guidance. And so they would say weak economic conditions are likely to warrant exceptionally low levels of the Fed funds rate for some time. The committee expects that a highly accommodative stance of monetary policy will remain appropriate for considerable time, and so on and so forth. So in order, I believe in order for people to be persuaded that monetary policy has a signaling component, we don't believe that all monetary policy announcements are the same. There is something special about how central banks communicate, and calendar-based forward guidance was particularly special. The moment they moved to threshold-based forward guidance, effectively the announcement had no information content regarding the economy, which is why we stopped to observe this kind of signaling component, in addition to economic uncertainty falling over that period. So it's a combination of factors that one needs in order to get this particular impulse response of US dollar changes to monetary policy surprises. Now, let me just present you with this complementary work that we have that is not in this paper to essentially emphasize why we believe it's indeed calendar-based forward guidance rather than QE. So here we move from the quarterly frequency to the effectively daily frequency, and we estimate this kind of projection method approach, right? So we estimate a regression where on the left-hand side, you have the exchange rate change between the day before the FOMC announcement relative to n days after the announcement, where n is just your x-axis. So this variable, this exchange rate change, is regressed on a particular monetary policy surprise that we use as an instrument effectively in our first stage in the results that we presented. So now we want to trace over time exactly when we see this kind of result in the data and what happens with the prior to and post the global financial crisis. So again, this is the early zero lower bounds. This is prior and this is post. So notice that regardless of which monetary policy surprise you use, it doesn't matter that much. So positive coefficient here implies that the results are consistent with the conventional wisdom, and a negative that they go against the conventional wisdom. So you see that actually our results at quarterly frequency kind of kick in after about 28 days or so in this particular regressions, meaning that in the very beginning, for those of you familiar with the daily literature that studies the link between exchange rates and monetary policy, you're probably used to reading papers that tell you, well, nothing was different over the financial crisis. And indeed, if you estimated the daily regression, you're actually going to estimate a positive coefficient, and you would conclude that nothing is different. However, over time, actually, you see that the relationship flips in a very significant way. While the estimated coefficient on the day is quite small, it becomes very negative and significant over time, and it persists. So in this particular paper, that is a complementary paper, we attribute that, we link it to the literature that explains this type of puzzles in asset pricing to a combination of slow-moving capital and heterogeneity in financial market participants, and there's wide literature that documents similar puzzles. So why is this forward guidance? Well, here we're using only non-QE dates, right? So this is dates only when there was a forward guidance announcement. If you take the QE dates, which also, of course, include forward guidance, but dates that had QE announcements, you see that actually the results are always consistent with the conventional wisdom. So it wasn't QE, it was indeed calendar-based forward guidance that is driving the results that we have. And if you just look at the daily literature, you kind of might be left with the impression that nothing was especially surprising over this period, but that will be not quite right, because the policy relevant horizons presumably are 1 month and above. And at that frequency, you see that actually the relationship flips in a very significant way. So let me conclude. So what do we do in this paper? So over the global recession, we documented decreases in US forward rates resulting from US monetary policy shocks ended up appreciating the dollar, contrary to common wisdom, and contrary to what essentially even Bernanke probably thought was happening at the time. So this happened for 2 reasons. The expected future excess return from being long the dollar fell. So there was a stronger safe haven effect here and flight to safety to treasuries. And the long run expected value of the dollar strengthened due to lower US inflation expectations. And we argued that a stronger signaling effect of monetary policy during the global recession period can jointly explain the empirical facts. And the last thing I want to emphasize before I finish, given the topic of the conference, that these empirical results, I hope, persuaded you that at least in one thing, is that it's very important to have models of currency risk premium that show that currency risk premium is correlated with monetary policy, because monetary policy is primarily transmitted through currency risk premium in the data. So thank you very much.
Okay, thank you, Vania.